So hello and welcome. This is the third session in the fiscal policy. In the previous two sessions, we talked about some very important aspects of budgeting in India, or what we call broadly as your fiscal policy. Fiscal policy is somewhat wider than just budget. Budget is a component of your fiscal policy. So there could be certain quantitative instruments like budget, but there could be certain qualitative aspects also in the fiscal policy, just as we see in case of your monetary policy. So we talked about the legal foundation or the legal mandate behind the fiscal policy in the very first session. In that particular session also, we talked about the accounting logic. What is the need actually, and what is the logic behind going for the budgeting process, and why it is such an important activity of the parliament. Then in the very previous session or the recent session, we talked about the entire accounting mechanism. How do we account for India's national, your fiscal expenditures, and where from we get taxes, what are the deficits, how are they calculated. And we, in fact, we talked about the very essence of fiscal deficit and its relationship with primary deficit. We again talked about revenue deficit and how we saw some states receiving funds in the means of which was the outgo of a revenue outgo for the central government, but a part of that fund is used for capital creation also, and that gives rise to your something called as very important effective revenue deficit. In fact, we saw some numbers also. When we saw about our expenditure, our revenue expenditures far outweigh our capital expenditure. We saw the particular nature of our expenditure also. So because of different fiscal consolidation measures of the government, we are trying to get a good fair balance so that expenditure, majority of our expenditure would be onto your capital expenditure. That means we'll be investing into certain infrastructure that can reinforce our ability to absorb shocks like your pandemic. We can be more productive, and in fact we can augment the national productivity and as well as the total national product also. So this is what we covered in the previous two sessions. So in today's class, we'll talk about the end portion or the last portion of how India manages its public debt. What exactly is public debt, that we'll also talk about. Then we'll go to the tax portion, because your fiscal policy consists of two major portions. One is your expenditure, the other one is taxes. So we'll talk certain important issue, we'll talk about certain important documents, we'll talk about one very important act, in fact, that brought in transparency and coherence in India's fiscal management. That's called your FRBM Act 2003. So let's start without wasting much time. So I'm switching to a presentation. So I hope it is visible. Yes. So let's start with this. So we started with something called your deficit financing. That means how does the government finances the deficits in its receipts? So the very first one, okay, the first thing that we saw is, just a second. The very first thing that we saw was government finances the deficit through external grants also. This is the very first thing that we can also judge. Yes, government gets certain external aids and grants from other governments also. In fact, at times government even gets internal grants also. So we can call it as entire thing as grants and assistance. Next, the most prominent one was your external borrowings, and there could be internal borrowings. So these two sections can be simply called as your grants and assistance. This is the borrowing section. But yes, government had a third option called as printing currency. You got it? I hope everybody is comfortable with this. So these are the different means through which government finances the deficit in the receipts. Next, let's talk about the public debt of India. As I kept on repeating things, that the budget document of India is of the nature of an income statement. That means we particularly talk about the finances of one particular year. Clear? We do not take care of, in the budget document particularly, we do not take care of the stock issue. That means how the things have accrued over the years. What is the current situation? That means how have we taken loans? What is the entire debt currently? Clear? So that's what is called as your public debt. So let us now understand what exactly is public debt. We keep on paying interest, right? While discussing the logic behind your primary deficit, So we talked about one particular, that is your interest payments. So we have taken a loan and these loans have accrued over the years and we keep on paying our interest. And we saw out of the revenue expenditure, 80 to 85% was simply interest payment. So these loans are very big. So now let's talk about what exactly is the meaning of public debt in India. Borrowing by the center and states, there is a mechanism or the constitutional provision. Article 292 of the Constitution of India, it says about the borrowing of the government of India. The executive power of the union extends to borrowing upon the security of the consolidated fund of India within such limits, if any, as may from time to time to be fixed by the parliament by law, and to giving the guarantee within such limit, if any, or as may be fixed. Because right, these languages are very confusing because constitution is a very legal document. So simply, we can simply say that Article 292 of the Constitution of India says about how the central government can borrow money. Clear? Note, government of India can borrow from both internally as well as externally. Next, okay, let me tell you, can a state borrow from external sources? Can a state borrow from external sources? That means some foreign thing?
Yes, sir.
Yes. But it has to be done with prior notice or prior permission of the union government. Without union government's permission, no state can actually borrow. From external, internally they can borrow. From external sources, they cannot borrow. They can borrow only if there is permission from the central government. So there is a legal mechanism to that and articles associated with that also. So we are not going that much deep into it. Next, the union government describes what exactly is public debt. Understand this particular thing. The union government describes those of its liability as public debt which are contracted against the consolidated fund of India. So all the liabilities or the corpus of the entire liability that has a contract against the consolidated fund of India is only called the public debt of India. You got it now? See, central government can have different liabilities, different loans, different liabilities. So any liability which is contracted against the consolidated fund of India, which is the biggest fund, right, that is only called your public debt. So the entire liability of the government is not completely public debt. Yes or no? I hope you all are okay with this. So the entire amount of liability that the government of India owes with is not entirely public debt. Some portion of it, in fact, majority portion of it is contracted against the consolidated fund of India, and that particular thing is only called your public debt. Then what about the other thing? The union government includes all other funds received outside consolidated fund of India under Article 266(2) of the Constitution, where the government merely act as a banker or a custodian. You can relate to this to your public accounts, yes or no? So when you put up your money in your PF account, it is not going to the consolidated fund of India. So that the entire money received in the public accounts is not included into the public debt of India, because public debt of India simply means it has to be contracted against the CFI, not the other. That means your public accounts. Is that clear to all of you? The second type of liability is called your public account, that all we have all discussed. Is that clear to all of you, or any difficulty with this? Those who are attending for the first time, you might find certain difficulty. Government of India maintains three kind of account. One is called Consolidated Fund of India, then is called your public account. Third one is the Contingency Fund of India. Clear? So out of this Consolidated Fund of India is of utmost importance. So any loan or any liability which has a contract against CFI is only included in the public debt of India. So homework for you today is find out the current public debt of India. The current public debt of India, you have to find out from figures. It is readily available. Clear? Next, now let's talk about the central government liabilities. What are the different kind of liabilities being borne by the central government? First thing, it could be internal debt. Yes or no? Government might have borrowed from you, me, and everyone. So anything, any liability that has come from an internal source within a domestic boundary is called an internal debt. Next could be your external debt. And the third one is, and these two things, internal and external debt, these all go into the Consolidated Fund of India. So these two include your public debt. Now the other liability which is not included in the public debt of India is called your public accounts liability. Yes or no? When you make a contribution to your PF or something, right, that's a liability for the government, because government has to repay it back with interest. Is that clear to all of you? So develop this simple logic, things would be very easy for you. Next, now we saw when we even started with your Fisher's quantity theory of money, on the left hand side we had our fiscal policy, and on the right hand side we had our monetary policy. So this equation, price into quantity is equal to money supply into your money velocity. The left hand side of the equation is entirely called your fiscal policy or money supply, right, your supply side of the economy, and this is managed through the fiscal policy. We particularly saw one issue attached, or that's we can say that's the characteristics of right, fiscal policy, that generally not just in India, it's a global phenomenon. Fiscal policy tend to be expansionary. That means governments always try to spend more, and that is constrained, that balance is achieved so that money has its value, so that we have a real return or a very sustainable kind of economy. Monetary policy tends to be somewhat contractionary, or we can say conservative, not contractionary, we can say conservative, that it every time poses a challenge whenever government tries to spend excessively or unprudently. In order to give a legal foundation, see, whenever we all know, yes, this is a kind of management, that our loans and our liabilities, that means arising out of our expenditure, have to be accounted for. They have to be very rational, they have to be for productive investments. But there is no legal foundation. So there is all the possibility that the politicians, that means our entire set of executives are politicians. So in order to satisfy their own vendetta, own objective, for example, to keep people happy by spending, right, by giving no care towards the fiscal consolidation or fiscal prudence or the long-term impact of that, we didn't have any legal foundation actually. So it was legalized by the Bajpayee government and the then finance minister, right? Who can tell me who introduced this act? Who played the very vital role in, right, execution of this particular act or passing of this act? Any one of you?
Manmohan Singh.
He was the, no, Manmohan Singh, no. Bajpayee was the prime minister. Was the
Sorry,
finance
Yashwant
minister.
Sinha.
Yes. Yashwant Sinha was the finance minister then in 2003, who played the vital role in promulgation and enactment of this particular act. The act is called often, very often it is called as your FRBM Act or Fiscal Responsibility and Budget Management Act. What it entails to, इसके compositions क्या हैं, what are the different, it's a very comprehensive act actually. Okay, can somebody tell me who headed the committee that helped in formulation of this act? FRBM Act, FRBM committee, right? He is NK Singh. So he is also an IAS officer and he happens to be the current, right, chairman of the finance committee. Clear? So Dr. NK Singh played, he took all the initiative in drafting this particular law and what should be the outline of this particular law. What it says actually, it says the enactment of the FRBM Act in August 2003 bound the government through an institutional framework to pursue a prudent fiscal policy. That means it limited the government's excessive expenditure. All of you know this. FRBM Act says our fiscal deficit should not be greater than 3% of our, not budget value, it is GDP. The fiscal deficit should not be greater than 3% of the current GDP. So it linked the expenditure or the budget size to the GDP of a country. That means, can you understand? Just imagine. There is all a humbug every time, right? There are lot of criticism, lot of books have been written. Why 3%? Why not 2%? Why not 4%? Clear? So this is a kind of normative and a very kind of nebulous kind of decision to why to limit it to 3%. But remember, for your exam perspective, that FRBM Act limits the fiscal deficit to be 3% or lesser as compared to the GDP of the country. But yes, every time, not a single time has happened since 2003 wherein the government has been able to stick to this particular number. Though it was initially mandated that the fiscal deficit needs to be kept under 3%, but not a single year has passed wherein we have reached this target. Every budget session, we go for an amendment into this particular act to allow for a higher fiscal deficit. Is that clear to all of you? Got it? So the FRBM Act aims to introduce transparency in India's fiscal management system. The Act's long-term objective is for India to achieve fiscal stability and to give Reserve Bank of India the flexibility to deal with inflation in India. When the government will be not spending excessively or irrationally, then it becomes easy for the central bank of the country to manage inflation. Yes or no? Tell me. Clear? Now, all of you are aware that budget is a very long legal procedure. So along with other documents like your finance bill and appropriation bill, demand for grants, right, explanation against the expenditures and all that, this particular act, this FRBM Act, introduced a new era into the transparency in the fiscal management, that while other documents are being placed on the table of the parliament, these 4 documents need to be placed in the parliament also. It mandated, and you can say it made it mandatory for the government to produce these documents in relation to the prudence in fiscal management in the parliament along with other documents of the budget. So kindly remember the name of these documents. Very, very important for your exam point of view, because you all know what is an appropriation bill, what's an finance bill, right? Other mechanisms, other documents related, demand for grants, charge expenditures, right? Annual financial statement includes 5 set of documents, but along with that, the right examiner's favorite is these documents actually, because we rarely read about them. So remember at least the name of these documents, because this name of the documents, they seem very similar actually. Read them, you can understand. Medium-term fiscal policy statement, macroeconomic framework statement, fiscal policy strategy statement, and medium-term expenditure framework statement. By heart these 4 names. These 4 documents are mandatorily to be produced in the parliament along with other budget documents as per this FRBM Act. Is that clear? The FRBM Act proposes the revenue deficit, all the deficit, the fiscal deficit, the tax revenue, and the total outstanding liability to be projected. This means total outstanding liabilities means your public debt plus the public account liabilities. They have to be projected as a percentage of the gross domestic product. Earlier, before the FRBM Act, we used to keep our number every time relating to the budget numbers also, the total expenditure. But this particular act created a bridge so that our fiscal management is in adherence to the national ability, that's your gross domestic product. So it mandated that all the deficits, all the figures of revenue, expenditure, receipts, all that need to be matched up with your GDP. They need to be expressed as a percentage of GDP. Is that clear to all of you? Remember the name of these 4 documents, very important for your exam point of view. So this is all about the expenditure portion which we talked. Next, let's go to the tax portion. So if you have any concern regarding this all expenditure calculation in right, budget deficit, fiscal deficit, primary and all, right, you can connect me after the class. So now let's go to the next area of the fiscal policy, that is the taxation policy or the finance policy. Now, I'm not going to list out the different taxes. You all are a little bit of aware, but at least we have a document named as Taxation in India. So there are certain 4 canons of taxation also, so you will get all that note also there also. At least most of you know that tax are of 2 kinds. Before starting this, let me tell you something. I read it somewhere, in fact, during my taxation classes, I read this particular thing, and you can very well relate to these all things if I simply tell it this in front of you. What's that? There are only 2 ultimate truths of life. There are two ultimate truths of life. One is death automatically. Life hai to death hai bhi. That's an ultimate truth. The other one is tax. If you are born, if you are living, you can never go away from the purview of taxation. Many a times we feel that I'm not paying income tax, so I'm not being taxed. You are being taxed through indirect taxes. So tax is something, it is all pervasive. Just as death, tax is also an ultimate truth of life. So it is everywhere. And in fact, you should not be surprised. Government is never happy or never complacent with the tax receipts. You very recently you might be seeing figures relating to a GST, it is crossing 1 lakh crore target every month. But beyond then also, a government naturally by its characteristics, it is never happy actually. It every time tries to see some other option wherein there could be a tax revenue. I'm giving a very small example. When our capital market was not that matured, it removed the capital gain tax so that more and more people participate in the capital market and it gets its frequency and vibrancy and all that so that it matches to the next level. But when it saw it is becoming already very vibrant and we have exempted this particular tax for a very long time, they reimpose the capital gain tax. In fact, long-term capital gain tax, short-term capital gain tax to tha hi, but about LTCG or long-term capital gain tax, they saw yes, we have created the market infrastructure through creation of a proper regulatory body called as SEBI and all that. Now people are enjoying and earning, and this particular area of the economy is not being taxed. It is not being tasked. So government thought of re-implementing the case of your long-term capital gain tax. So all of you are aware about this very recent news tha. Next is, please don't send any chat now. Next, about tax reforms. All of you know, we every time, right, we have a hesitancy towards giving tax. So now let us talk about how this archaic system of very regressive taxation system have been, well, government has tried in all the spheres of taxation so that it becomes more progressive. So let's start with the tax reform, and let us start with what are the issue majorly with your indirect taxes and how they have been progressively improved upon by the implementation of the GST. These indirect taxes, they contribute around 45% of the total tax revenue. This number could be 46, 47, 43, 42. It changes from time to time. But for your basic एक overview रखने के लिए आपके लिए, right, it contributes around 45% of our tax revenue. The rest 55% is contributed by your direct taxes like your income tax and all that. So a major source of, yes.
इस साल चेंज हो गया है सर.
Okay.
Pandemic year 55-45 हो गया, उल्टा हो गया है.
Okay, because of pandemic, this number have changed, and this has become 55, and income tax has reduced to 45%. The direct taxes have reduced because of the pandemic. So it changes, right? You need to be updated. A major source of indirect tax is excise duty, which is payable on value of manufacturing activity in the economy. Clear? Some excise duty on certain things. What is excise duty? When you produce anything, right? When you produce any goods, you need to pay a tax simply on the production. That's called as your excise. But yes, this excise duty has been subsumed into your GST, but not excise on everything actually. For example, alcohol, petrol products, they're not yet included into GST. But yes, let us now have a brief idea about how it was, so you can say, very aggressive. Issue with the excise duty क्या थे जो GST आके reform किया? Excise duty, like other indirect taxes by inherent structure, is regressive in nature. Why it is called regressive? Understand, in taxation you would see these two words, regressive and progressive. Understand these two meaning of these two words. What does it mean actually? The tax burden, what is the meaning of a regressive tax? The tax burden is higher on the people with lower income. And that is what is meant by regressive. Somebody who is not earning much, he is paying the maximum portion of that particular tax. जिसका इनकम लेवल ज्यादा है वो तो ज्यादा टैक्स दे सकते हैं. That's called your the progressive tax. Think of the income tax slabs. If you are earning between 5 to 7 lakh rupees, you need to pay 10%, for example. If you are earning beyond 8 lakh, you need to pay 20%, beyond 10 lakh, 30%. This is called as progressive tax. That means when your income goes up, you pay more proportion of your income in the form of tax. That's called like a progressive taxation. But regressive is just the opposite of that. Somebody who is paying less, who is earning less, he is paying majority of his chunk in the form of tax. That's called a regressive. Secondly, the multiple excise structure with multiple rates giving a different interpretation on the tax payable, giving scope for evasion, litigation, and revenue loss to the government. These all problems, to certain extent, to a very good extent, in fact, have been reformed or have been solved or reformed, you can say better, by the implementation of your goods and services tax. The third issue is excise is cascading effect. What do you understand when I say cascading effect? What do you understand? Cascading effect means tax on tax. That means you make something on 10, you pay rupees 12 as tax. Again, you are being taxed on this entire thing. That means if you add a 20% tax on this, the 2 rupees tax that you paid, you are again paying tax on this 2 rupees also. Rather, you should be paying tax on this 10 rupees only. This is called as cascading. Tax on tax is called as your cascading impact of taxation. Next. So what are the different steps that have been taken to curb the issues relating to your excise duty? But beyond that, we had our major reform in GST, जिसके बारे में हम लोग थोड़ी देर बाद बात करेंगे. But prior to GST, what are the different steps taken to better it or to make it better, the excise duty? The government had tried to address this issue by reducing the slabs of the excise duty only, lower excise duty on essentials or mass goods to minimize the regressive character. So essential item गरीब भी यूज करता है. So the excise duty on the essential item or the mass goods were reduced so that it loses or it sets some of its regressive nature. With regard to the cascading effect, the best way to prevent it was by introducing value-added tax. So the regressive nature of any tax can be very simply be done away with a mechanism called as your value-added tax. That means if you buy a raw material at 10, you make it a material worth rupees 20, that means make it 15. You added a value of 5, you need to pay tax on this only, not the entire 15 rupees. This is called as value-added tax. That means you added value to the raw material which you bought at 10 rupees. Now you made it a value, so a material worth rupees 15. So you have added a value of rupees 5. You need to pay tax on this 5 only, not the entire 15. If you are paying the tax on the entire 15, that would be called as your cascading. Yes or no? That is what is called as your cascading. Next, an initiation was made with the government by first introducing the modified value-added tax or MODVAT scheme, which allowed partial adjustment of duties on capital goods purchased. However, it was restrictive in nature. You don't have to go that in depth into now at this point of time. We'll talk about the taxation, how it is calculated, all that in a separate class. Just understand these all things had happened. The government replaced MODVAT with Central Value-Added Tax or CENVAT at the central level during 2004. A major reform has been at the state level with replacement of the sales tax with state VAT. And who gave the credit for this particular concept of state in place of sales tax, the state VAT, the credit goes to Sri Asim Das Gupta, the then finance minister of the West Bengal. It happened in 2004. And in fact, West Bengal and the finance minister of West Bengal, the state finance minister of West Bengal, have been the major voice in the reformation of indirect taxes. If you talk about GST, the GST Council, in fact, that documented that entire GST Act, right? Do you know who was the finance minister of Bengal, West Bengal, who played the very major role here? It comes often in the question actually. Find it out. He was the finance minister when GST was implemented. So it's a homework for you today. Find out. He was the finance minister of West Bengal, and he's a very revered finance minister all around the country actually. So one of the finest State finance minister I have seen during my tenure or whatever I have been reading state finances. West Bengal comes under my purview, so I have a deeper interest in their budget also. So that's what. So find out. This is a homework for you today. Next, let's go about the direct taxes. So direct taxes as of now are very progressive, but there was a time when we needed some kind of modification or improvement. Direct taxes contribute a 55 and now it has changed as per Prithvi, it is 45 because of the pandemic. And it's a better way of taxation as it is progressive in nature and based on the ability to pay. Direct taxes have been progressive since a very long time because it is based on the ability to pay. And that's what is called a progressive form of taxation. Higher income, more the tax rate, leading to greater revenue with least burden on the masses or those with low income. Direct taxes, particularly income tax. Can somebody tell me some other direct taxes? Just not income tax. There are some other direct taxes also. Can you tell? Income tax, whenever I say income tax, it relates to an individual. Clear? What about the companies?
Corporation tax.
Yes, that's called your corporation tax or corporate tax. Anything. Any other direct taxes?
Wealth tax.
Wealth tax, yes. Gift tax. Anything else? Capital gain tax. These are all direct taxes. Clear? So there could be a question where you would be given 5 taxes and you would be asked to find out which one is a direct tax, which one is not a direct tax. So you should know the list of direct taxes. Clear? And one more homework I am giving you prior to the GST class. Almost many of the central acts and state acts have been subsumed into the GST. But there are certain tax or either tax on certain things which are still out of the purview of your GST. Petroleum, alcohol, ये सारी चीजें हैं, but there are certain other things also which might come in your exam, and if you do not know, you cannot answer these questions. So find out which things are not yet included into GST. They are out of the purview of the GST. It's a very important question. So the progressivity of the income taxes in period of inflation pushes people up the tax bracket as the pay packets get inflated due to inflation, resulting in higher taxes paid, reduced spending by the individual. Yes or no? Whenever there is inflation, automatically your wages should increase. So from the 5 lakh bracket, you might go to 7 lakh bracket. So you'll be paying a higher proportion of that in the form of tax. So this is how inflation is related to direct taxes. Could you understand the relation? If there is inflation, automatically, generally, unless until it's a case of stagflation, right? People start earning more because you have your DA component. The dearness component is used for compensating you for your inflationary expenses. So when you earn more, you go to a higher bracket and you pay a greater percentage of or a greater fraction of your income in the form of tax. So the tax buoyancy comes. So what are the ways through which taxpayers and tax revenue can be increased? If you are being asked a question, kindly suggest certain ways through which the tax revenue or the purview of the tax budget, tax net can be increased. Increasing the direct taxes, increase in the tax base, enforcement of the tax compliance. Clear? If you increase the tax base, more people will come under the net. It is in fact increase the direct taxes, rather it should be, is it right? If you increase the direct tax rates, automatically the tax rate would be, tax collection would be higher. But there is a relationship between optimum tax. Can somebody tell me which graph or which theory shows you the optimum level of taxation? If you increase the rate of tax beyond that, automatically the tax collection revenue would decrease. Does anyone know about this particular graph? There's a theory. Try to explore this one also. There is a theory that shows you what should be the
Lorentz curve.
Lorentz curve.
I think so.
Find out. Okay. So there is a theory or a curve that helps you find out the optimum level of tax, wherein you get the maximum tax revenue. If you go below that, you are revenue foregoing. If you go beyond that, you are losing again revenue because lesser people would be paying taxes then. So there is a curve actually that helps you. Next, increasing the tax base, it is fine automatically. When you increase enforcement of the tax compliance, automatically your revenue grows. Next, let's talk briefly about your goods and services tax, which is a progressive or perhaps the most progressive indirect tax system all over the world. But yes, if you go from country to country, you would see a certain tweaks in the thing. That means it is very endemic. The way GST is being implemented in India may not be the very same it is being implemented in New Zealand, it is being implemented in Australia, or it is being implemented in the United States. So there is to be local, you can say local fabrication into the, but the concept is the same, that we need to subsume all the 20-30 indirect taxes into just one, and it will have three components basically: state, central, and integrated GST or IGST. Next, let's talk about that. India's biggest tax reform since independence, GST, which came into effect on the 1st of July 2017. GST aims to make India a common market with common tax rates, procedures, remove the economic barriers, thus paving the way for an integrated economy at the national level. By subsuming most of the central and state indirect taxes, state it is rather you write indirect taxes into a single tax, and by allowing a set of prior state taxes for transaction across the entire value chain. Can somebody link something? Set off of prior state taxes, this is called as your input tax credit. That means if you have paid taxes earlier, you can show that and get a tax credit that yes, I have paid. Or else if you are paying it up again, you can get a refund. That's called as input tax credit. This mechanism is there in GST. It was there also in VAT also. It mitigates the ill effects of cascading, improve competitiveness, and improves liquidity in the business. Because of the cascading effect, or even in the case of your VAT, clear, you used to lock up a lot of your revenue in the tax mechanism. So when you are locking up your money in the tax, that you are to get it refunded, don't you think you are sacrificing certain amount of your liquidity? Yes or no? Your money is getting stuck there. You need to wait to get it refunded. Clear? So this improved. This concept of input tax credit helped improve the liquidity even in the businesses. Next, GST is a destination-based tax. Earlier, it was a, tell me, source-based tax. Before GST, most of the indirect taxes were source-based tax. Now it is a destination-based tax. What does that mean? For example, anything is being getting manufactured in Tamil Nadu, that is being transported is, for example, to Nagaland. A motor vehicle is being produced in Tamil Nadu plant, and it is reaching for final consumption or final use in Nagaland. Earlier, before GST, Tamil Nadu had the power to tax on this, whatever is manufactured, and this is called as a source-based tax. But now, after GST, Nagaland gets the right to tax on that because it's a destination-based tax. Got it? And because of the change in the tax architecture in India, there was a compensation mechanism that the central government guaranteed that any revenue loss because of the implementation of the GST would be compensated, and for that we had a compensation cess, about which you very recently saw central government didn't pay out the state government under certain extent because of the pandemic, right? There was a heavy loss, but the loss was not because of implementation of GST, rather it was because of what? The pandemic. Nobody knew the pandemic is coming actually. Government guaranteed that any loss in the tax revenue of a state because of the change in the tax architecture would be compensated, and for that they implemented a compensation cess. But since it was legal, it was not mentioned actually any loss due to GST, any revenue loss. The legal document was, when it was enacted, the document simply said any revenue loss of the state would be compensated. Because of implementation of GST was not written actually. But when the case went to Supreme Court interpreted it this way only. The loss has to be because of implementation of GST, not because of anything else like your pandemic. Clear? So this is how the GST is. So let us now understand the significant features of the GST, or the salient features of GST. GST would be applicable on the supply of goods as well as services, or against the present concept of tax on the manufacture or sale of goods and provision of services. It made goods and services the one and the only. Goods and service tax is the single comprehensive indirect tax operational from 2017 July, right from the manufacturer or the service provider to the consumer. It is a destination-based consumption tax with the facility of input tax credit in the supply chain. It is applicable throughout the country with one rate for one type of goods and service. Earlier, different goods and services had a different tax rate in different states. The government simply did away with this. It has amalgamated a large number of central and state government indirect taxes and cesses. It has replaced large number of tax on goods and services levied on production, sale of goods and provision of services. So it subsumed many things actually. So the major taxes that were levied by central governments were, before GST, they were central excise duty, service taxes, central sales tax, cess. The major state taxes were VAT, sales tax, entry tax, luxury tax, octroi. These are the taxes imposed by local government, like your panchayats or municipality corporation. You have a right barricade gate once you enter to the any panchayat's area through any goods and anything that they collect tax. That's called octroi. Entertainment tax, tax on advertisement, taxes on lottery, betting, gambling, state cess on goods, etc. They have all been subsumed into GST. But your homework today, find out the taxes which still exist, which are not under the purview of GST. Very important for you. Try to explore. GST is categorized, the entire GST is categorized into three things: CGST or central GST, SGST or state GST, IGST is called as, tell me, what is IGST full form? I stands for what? I hope I'm audible to all of you.
Sir, integrated GST, sir.
Yes, I stands for integrated GST. So this could be a question also. Clear? Next, intrastate supply of goods and services is when the location of the supplier and the place of supply different. In intrastate transaction, a seller has to collect both CGST and SGST from the buyer. The CGST gets deposited with the central government and SGST gets deposited with the state government. So whenever you see a bill, you would see SGST written separately, CGST written separately, IGST written separately in the bill. Interstate supply of goods, interstate means within a state. In case of interstate, is where the location of the supplier and the place of supply are in different states. In an interstate transaction, a seller has to collect IGST from the buyer. So this is a kind of the central sales tax or the CST that we are paying. It is collected by central government and paid back to the corresponding destination state. Next, central and goods taxes. So what is CGST, what is IGST, what is SGST? You need to follow this, right? आप पढ़ लेना थोड़ा बहुत इसके बारे में. It is good. We have different slabs, right? All of you know we have different slabs of GST. Next is your GST Council. This is a constitutional body or a statutory body? Tell me. GST Council is a constitutional body or a statutory body?
Constitutional, sir.
As per article number, find out. This is how you read actually. This is how you explore. Why it is constitutional? Because GST Council has a special mention in the Constitution of India. We had to go for an amendment, right? All of you remember. We had to go for a special class of amendment which was changing the federal structure of India, because earlier there used to be express power in taxation to certain segments. In case of goods, up to manufacturing, central government had the express power. That means excise duty, other than certain very small number of goods, excise duty was the sole purview of central government. But once goods were manufactured, it was purely on the state that they had the purview of taxation. So there was no express power in goods and services. But because of GST, implementation of the GST, we gave both center as well as states the express power to tax on goods and services. Earlier, service tax was on the purview of central government only. State government didn't have any say in the service tax. But now, all of them have the power to enforce the tax as well as collect the tax also. So now both central government and state government have express power in taxing. So the GST, and this is what actually changed the federal structure. Earlier, there was break in the express power. In goods, up to manufacturing, central government, after manufacturing, state government. In services, purely central government. This was a change. So this completely changed that we made everything into sync actually. So we needed a special kind of amendment in the government which has to be amended in the Parliament Act, which has to be ratified again by more than 50% of the states. All of you know this is a special kind of amendment. Whenever you are going to change the federal structure of India, you need to go for 50% states need to also support or re-ratify that act. Then only it will become an act. Clear? GST, the hell lot of difficulty in implementation of GST because of this particular provision. Central government was not able to garner support of more than 50% states. When it came, we went for the thing. It has been specifically provided that the GST Council, in its discharge of various functions, shall be guided by the need of a harmonized structure of the GST and for development of harmonized national market for goods and services. So tell me, what is the composition of the GST Council? Who heads the GST Council? Prime Minister or Finance Minister?
Finance Minister.
Yes, not the Prime Minister. Finance Minister heads the GST Council, and Finance Minister of all the states are the member of the GST Council. Clear? And GST Council is a very rare example of cooperative federalism. How it is? Because if you check for the percentage of votes being given to state and center, state governments combinedly have a greater weightage or a greater percentage of votes in the GST Council, and hence this is a case of cooperative federalism. We'll have a complete class on GST, don't worry. The GST Council has established a mechanism to adjudicate disputes arising out of its recommendation or implementation of thereof, and it has a power to adjudicate issues or, right, you can say disputes arising between states or any party. Next, because of the implementation of the GST, there is a widespread view that some people might have this profiteering motive. They might make use of this transition in the law to make undue profits, and for that government implemented or enacted or government formed National Anti-Profiteering Authority, or it is called as NAA. Read about it somewhat. What are the various jurisprudence or jurisdiction of this particular NAA or National Anti-Profiteering Authority, how it works, right? When does it have the power to enforce something? Read about that. We have everything in the notes itself. So because of the transition of the earlier older form of tax to the new form of tax of GST, there is a widespread view that some traders, some businessmen might take this advantage of the transition to make some undue profit. So in order to avoid this undue profit, why it was expected, right? Let me just make you understand. For example, there was a goods which was being sold at ₹80, and above this there was 10% tax. I'm talking about a period earlier to GST. So ultimately the consumer was paying ₹88. Clear? Now this 10% tax slab for this particular thing was reduced to only 5%. It was reduced to 5%. After the implementation of the GST, the new tax rate became 5%. So what this seller is saying, earlier the good was being sold as 80 and people were ready to pay 88 including taxes. Now the tax component has reduced to ₹4. Let me increase this price of 80 to 84. So that people will be also buying at same 88, but I will be making extra ₹4 profit. Yes or no? So the reduction in the cost of or the price of goods, which was because of the reduction in tax, might be used by trader to make undue profit, and hence we implemented or we created an authority to check particularly this thing called as your profiteering, undue profit. Got it? The institutional framework comprises of the National Anti-Profiteering Authority, a standing committee, a screening committee in every state, and a Directorate General of Safeguards in the CBEC. Central Board of Excise and Customs is the nodal agency for the implementation of this National Anti-Profiteering Authority. So it has a Directorate General of Safeguards against the profiteering in the CBEC. So the IT framework needed for the implementation of GST is called a GST Network, right? So these are the facilities that it provided. Who handles the GST Network? Tell me, which IT company started providing the services for the GSTN?
Infosys.
Yes. Initially, GSTN, when it started, Infosys was the agency which provided these IT services. Clear? GSTN is a company actually. Got it? It's a company and it has different promoters also. Try to find out who are the owner of GSTN. That could be a question also. Next. About black money. What to say about black money? All of you are aware. I included this in the slide that you need to read everything in comprehensive. Next, what has the government done to curb black money? All of you know the biggest instrument is the demonetization policy, but there is all the criticism whether it acted for its purpose, whether it became fruitful or not. So there are differentiating views. So you have your own views with all the data and all. Next, let's go. So this is all about demonetization benefits. What is an efficient tax system? When do we say tax system to be efficient? Remember BECN, these are the acronyms. An efficient tax system should allow raising revenue without burdening the common man, right? It has to be progressive actually. It should provide for BECN briefed as below. First is buoyancy. What is tax buoyancy? Raise tax revenue with increased growth of an economy rather than by changing the tax rate. When should there be buoyancy in the taxes? What's a rational or a sustainable buoyancy in the tax rate or the tax collection? Only when there is more economic activity and more tax is coming. Not that earlier you were taxing 5%, now you are taxing things on 10%. That's not sustainable. E means effectiveness, promoting the tax compliance. We should develop mechanism that improves the tax compliance. So whoever is liable is paying up taxes, so you should have good vigilance in this. Next is cost effective, lower cost of collection with increased tax revenue. This is called as the canon of economy. I will teach you during the taxation, don't worry. Think of a situation. For example, government introduced a new tax. Let us assume, let me make you understand what is cost effective. Government introduced a new tax. For example, government knows if I implement this particular tax, I will get a revenue of ₹100. For example, government made some calculation through some projection and government is saying, if I implement this new tax, I'm going to get tax collected ₹100. But what did they find? When they started collecting this tax, they have to spend 120 rupees because tax administration has an expense. You need to employ a tax collector, you need to have an IT mechanism, you need to have people to compliance, people for enforcement and all that. So the expense of tax administration is greater than the amount of tax collected. So is there any good thing that's happening with this new tax? No. We are wasting money, right? We are collecting 100 rupees, but we are spending 120 rupees to collect that 100 rupees. So this is called as cost effective. So the amount of tax collected has to be far higher than the amount being spent on the administration of that particular tax. Next is, it has to be neutral to economic decisions. What is the meaning of that? Not influencing location of the business. That means earlier there used to be a trend because of lucrative tax incentives, different business used to be located on particular location. Clear? Forget about infrastructure. Infrastructure is something that you can create and you can genuinely bring in investment into your particular place. But simply by reducing taxes, if you wish to bring in investment, This is not a good thing. Clear? So it should be neutral to economic decision. This should not be one of the agent through which companies or institution must be deciding on whether to make investment at a particular location or not. They have to be location neutral or business decision neutral. So these are the 4 elements which make a taxation system an efficient one. Okay, so remember these things. So now let's end this session with certain 2-3 questions. So the first question, which of the following is a typical components of a government fiscal policy? Budget expenditure, resource mobilization, deficit containment, fiscal transfer to lower levels of government. Tell me, which of the following is our typical components of a government's fiscal policy? Which all things are generally taken care by the fiscal policy? Budget expenditure, yes, of course. Resource mobilization, yes. We talk about new forms of taxation. Deficit containment or financing, yes, we talk about budget financing, right? How to borrow or what to do. Fiscal transfer to lower states, yes, we talk about grants to states, loan to states and all. So hence the option, right option is your all the above. Got it? Questions could be of this standard, understand? Next, what are the objectives of the FRBM Act? We just read in this particular class. Introduce transparency in the India's fiscal management system, yes, obviously. The Act's long-term objective is to India to achieve fiscal stability, yes, obviously. Give the Reserve Bank of India flexibility to deal with inflation in India, yes, it gives greater flexibility. Introduce more equitable distribution of India's debt and all the above, yes, obviously the 5th one option, yes or no? Are you all following up?
Yes, sir. Yes, sir.
Next question. FRBM Review Committee in 2016 is headed by? FRBM Review Committee in 2016 headed by? Tell me. This is a current affair question. N.K. Singh drafted the FRBM Act and he also headed the FRBM Review Committee in 2016. Got it? Next. Fiscal deficit is equal to, tell me, total expenditure minus total receipts excluding borrowing. Revenue deficit plus capital expenditure minus non-debt creating capital receipts. C is total borrowing. D is all of the above. E is none of the above.
Yeah.
Sorry?
Yeah.
Yes, it's option D. How many of you are comfortable with this particular option? That's why I kept on telling you, are you all comfortable with calculation of deficit and writing them actually? If you simply remember, borrowing means fiscal deficit, but you need to know now what are the different entries in the receipts, individual entries, and how do you adjust that? What exactly are you getting there? So this option should be very comfortable. You all should be very comfortable because questions will be like this. The entire accounting thing that we saw in the table need to be written in a language also. You should be very comfortable with this. And we have in our notes and PPT, we have everything. All of you know this. Next. Which of the following is not an example of fiscal policy? Additional government spending, a reduction in the budget deficit, an increase in the minimum wage. Is it? Relaxing credit conditions? Which one? Credit condition is about monetary policy, yes or no? Minimum wage somewhat income expenditure related. Next, excess of the total expenditure over the total receipts less borrowing and interest payment is called as? Interest payment is being done away with, so it has to be automatically primary deficit, yes or no? So be very this fast and this comfortable. Which among the following is not accounted as expenditure in a government budget? Government budget, which of the thing is not accounted for as an expenditure? Transfer payments, subsidies, disinvestment proceeds. It's a receipt. Capital infusion into PSVS, it's an expenditure. Debt service is your interest obligation. So disinvestment proceed is a receipt, it's not an expenditure. Got it? Which of the following is considered to be a tool of government fiscal policy? Cash reserve ratio, statutory ratio, repo ratio, reverse repo, taxation. Yes, this one only. These are all the tools of monetary policy. So this is all about today. So I hope all of you enjoyed it, and we are completing this session on the budget and everything. We'll have a separate class for taxation in India. Clear? And we'll have two more class on one class would be on budget of India 2021-22. The other one would be on economic survey. So that's all for today. Have a great day. Revise properly. Thank you.
Thank you.
Thank you, sir.